take two. Welcome back to Sin City Crypto Live. My name is David. I'll be one of your co-hosts. And today, for our FOMC special day, we are going to be joined by two special guests along with your two favorite co-hosts, me and Robin. We're going to talk about, obviously, the FOMC. We're going to talk about the members. We're going to talk macro. We're going to talk Bitcoin. We're going to talk crypto. We're going to talk a lot of things. And so before we can get into any content, and also we got a sneak peek, a leaked video of Jerome Powell's press conference from earlier today. We're going to take a look at that. But before, I'll let you introduce you to your other co-host. Hello, Robin.
Hola! It's your boy, Big Rob, back in the house. Welcome to Sin City Crypto. If it's your first time checking us out, we are an entertainment-focused cryptocurrency channel where we take the old, boring, and stale press conference and turn it into a fun and sexy broadcast. And Bitcoin, still at the same spot, 23,000.
Yeah, well,
What's that?
you know, I want to share a picture here. Did you see? Did you see Jerome Powell? You see what he did? Take a selfie.
He took a selfie?
Yeah.
Oh, yeah?
Yeah, it's
What
not a good look, bro. Not a good look.
Oh.
Yeah. All right, all seriousness, everyone is expecting the market to dump. Prices are kind of trading sideways. I know the Dow Jones was down a little over 200 today to open. Why do you think that is? If 25 basis points is already priced in, right? And obviously they're slowing down. So after 25, maybe one more 25 until the end of the year and then a pause or a reversal. Why do you think people keep driving the sentiment of, oh, he's going to dump on the market. He's going to scare the market. And people are kind of keeping their money on the sideline. Well, why do you think that is?
I don't think he's trying to scare the market. I just think that's a natural overreaction from what is said in his press conference and his briefing. And if you look at the 0.25, that's pretty much a foregone conclusion. I don't think there's many people are pushing back on a different number. Not to say that it's impossible, but more than likely, realistically, 0.25 interest rate hike is what we're going to get. And what we're really looking for is this press conference to break down what direction they're going to go in the future. What is the sentiment of the Fed and where they think we are right now and what to expect in the future. And if he gives little pieces of hope for a reversal or a pause, or vice versa, it's going to drastically move the markets. People are going to overreact to every word that's said. Not to mention, there's even trading bots out there. We discussed this the last FOMC meeting we had. There's trading bots out there that just simply trade off of words. So they'll buy and sell if he were to say something bearish or bullish. So,
all right, so let's take a peek at what the crypto markets are doing. So Bitcoin, we did see it. I called it a flash crash, but of course I'm exaggerating here a little bit. But it did dip down about 22.6, got back over 23. It was trading there earlier today and yesterday, and it's sitting at that 22.9 level. And guys, also our two special guests. We have Caleb Franzen from Cubic Analytics, big macro, big Bitcoin guy. He's going to be joining us. Also, one of our favorites, Magic Internet Money, will be joining us a little later. So we'll have tons of charts for you guys. So make sure to stay tuned because we have a lot of content coming your way. ETH 1570. So you can kind of see on the last 1 hour, everything is pretty much flat. Cardano is down 0.5%. Doge is down 1.2%. And Polygon Matic down 0.5%. Majority of these tokens are still in the green over the last week. But who knows how the market's going to react? Well, we can take a look at how the markets reacted last time. And so I'm going to swap over here. So I got this Bitcoin chart. This is the 30-minute chart on Bitcoin. And I went back to December 14th. So this first one, I got it highlighted here, 30 minutes prior to the rate hike. This is on Bitcoin. This is what we saw. A long-legged doji to either side, right? And so what this typically signifies is traders don't really know, right? They haven't made their minds up. The bull, it's like a tug of war, right? The bulls are pulling, the bears are pulling. Indecisiveness in the market. And then the next one, this large red candle, that was when the rate hike was announced at 11 a.m. Pacific Standard Time. And then each of these candles represent 30 minutes. So you can see here right at 11:30 after Jerome Powell's press conference ended, another red candle. So all in all, from the moment that the rate hike was announced from this top wick here, we saw a drawdown of about 4%. So will we see the same thing? What did the NASDAQ do, right? So NASDAQ actually printed a green candle, albeit a small one, 30 minutes prior to the rate hike. And then at the, and of course, you guys remember in December, that was the first non-75 basis point rate hike where the Fed went in and did 50 basis points. Still, then, right after his press conference, we saw this big red candle from 11,341 down to 11,181. So, will the markets do the same? I want to take a quick look at the VIX. Looks like the VIX is kind of in a bear flag pattern here, but trending upwards. But again, we do have our chart specialist that'll be joining us. We'll ask them to take a look here shortly. Now, I want to play, this was leaked. This was leaked. Jerome Powell press conference. Let's take a look at what the man had to say.
Thank you for being here for legal purposes. I actually just woke up an hour ago, threw on a suit, and didn't even wash my balls, but it's okay. As you all know, I'm Jerome Powell, and let me tell you, inflation is a real pain in the ass. I heard some poors on the streets complaining about $8 egg prices. Like I was saying to my good buddy Kashkari that day, what could an egg normally cost man? $10. Just seems like a lot of unnecessary complaining. Back in my day, a G-Wagon cost around 100 bands.
Back in his day. So can you believe he's out here calling us poor, saying we're complaining about $10 egg prices? Man, of course, guys, this is just a parody. This is from Carl B. Menger. Said, Justin, F your puts, F your calls. Jerome Powell will have you by the balls. So we have a couple things. So a couple of community members I want to highlight. First and foremost, Rocco, who was it that upgraded to a whale member?
It's a Crypto 420.
Crypto 420 just upgraded to a whale member.
Rocco, run the animation.
Run the animation.
Here we go.
Let's give our man some love here for the highest levels.
There we go.
My boy.
We got a new whale member, so that makes 5 now. The all elite cast of Jimmy, Brokioshi, Marky Mark, Crypto Billy, and now Crypto 420. So we appreciate it. Also, speaking of Jimmy, the man has struck again. The hype man of Sin City Crypto gifted 10 memberships. Guys, there is something you click in the chat where it says allow gifts or gifted memberships. Make sure you have that on if you want a free membership from our hype man, Jimmy. All right, Rob, let's dive right into some
love to the chat. How about that?
Yeah, go ahead.
All right, so we do got some new people here. Let's get this thing pumping. We have 40 likes and 160 people in here. Mathematically, that makes no sense. So if you like what we're doing, you like us streaming early, you like the Fed special, do us a favor and hit the like button. Otherwise, we will not continue. We will not move forward until we get to at least 100 likes.
So we're waiting, or?
Yes. Also, active in the chat. Put a 1 in the chat if you like my shirt. Hey, because David does not. Put a 2 in the chat if you do not.
I don't like your shirt. I like your shirt if we're going to like a nightclub or something.
No, let's do 1 if they like your shirt.
No.
2 if
1 if you like Big Rob's shirt.
And 2 if they like David's shirt.
What if they like both?
Oh, what's your favorite shirt?
3 if they don't like both of you.
3 is you don't like neither.
4 if you like both of ours. 5 if you don't care. 6 if who knows.
No, 1 Rob shirt, 2 David shirt.
It sounds like the Feds coming up with a number.
Oh, there's a lot of numbers thrown out here. Jesus.
A lot of numbers.
A lot of...
Okay.
The chat has spoken.
What is the chat saying? The chat saying they hate your shirt?
There's a trillion ones going on here. All right.
Said it's nice, but the white throws me off. Yeah, a lot of things about Robin throw me off. Join the club.
All right.
The number 8.
8
Sun God put 1 through 9.
1 through 9.
That was fun though.
All right. If you're new here, say hello so that way we can drop an hola back at you. All right. So some of the new people we have in the chat, we have True Dooku S. DeVille. We got John Forrest Crypto, ADH Engineering, Saeed. We got Cameron. We got Crypto Baby Isaiah, Darius For Real, Bit Green Sun 9. He also dropped an hola with the wrong letter. He dropped an ole. So then we also got Hoons as well in here. To all of you, hola! Welcome to FOMC Sin City Crypto.
I want to kick this off. So if you've ever wondered, right, and I'm not saying you guys don't know what the Fed is. If you ever wanted a little bit of history about the Fed, how it was started, what is the main purpose of the Fed, and in comparison to where we are now and how that's changed, we have a special video that Kyler put together for you guys and for us. And we're going to show it. It's a 3-minute video. It's a great one just to give some insight, and we'll hop right into the content. We'll bring our first guest on. So without further ado, President Woodrow Wilson signed the Federal Reserve Act into law on December 13th, 1913, after the Panic of 1907 forced the government to look to wealthy investors like JP Morgan to bail out the public. Although the Fed currently serves as a conductor of monetary policy and maestro of our economy, price stability, max employment, and interest rate maneuvering weren't part of the original Federal Reserve's duties. They were created simply to make the American banking system more stable and improve the flow of money, which in turn will put the American public at ease in regards to their money being safely held at their local bank. Fast forward over 100 years, and we now have arguably the most powerful entity in the world with the power and capability to sway not just the American economy, but the global economy in its entirety. The Federal Reserve System consists of a chairman, vice chairman, 5 board members, and 12 district presidents spanning across the continental United States. This group of individuals are referred to as the Federal Open Market Committee, aka the FOMC. They meet 8 times a year to discuss and vote on monetary policy. The Fed has 5 main objectives: manage inflation, promote maximum employment, supervise the banking system, maintain the stability of the financial system, and provide banking services. Over the past 12 months, the Fed's main focus has been to get inflation under control by increasing the federal funds rate. The federal funds rate, also referred to as the FFR, is the baseline rate that banks use to borrow and lend money to one another. The FOMC has the power to vote to either increase or decrease the FFR, which in turn increases or decreases borrowing costs to consumers. Here's an example. The Fed increases the FFR by 50 basis points, or 0.5%, which makes it more expensive for banks to borrow money from one another to cover liabilities and meet reserve requirements. This in turn causes what's called a ripple effect, where banks pass that expense down to the consumer, aka you. They raise the interest rates on your credit cards, personal loans, car loans, and home loans. This tactic of raising the FFR is so the Fed can siphon money from the economy, which decreases spending as borrowing to purchase goods becomes more expensive, which has a direct impact on prices, aka inflation. The idea is to quell demand, suppress inflation, and stabilize prices. What kind of impact has a higher federal funds rate had on the economy thus far? Let's talk about it. So, we're going to talk about housing. We're going to talk about the yield curve. We're going to talk about macro. We're going to talk about crypto. We're going to talk about Bitcoin. If you guys like that video, a lot of time and effort was put in by our man, Kyler. Make sure to like this video. And if you haven't subscribed yet, please make sure to subscribe as well. So let's start with let's just kind of go through this real quick, okay? So the first thing I want to go over is, what does the federal interest rate hike impact, right? Well, on the left is rates that are likely to rise, credit card rates, new mortgages and adjustable mortgages, new car loans and savings and CD accounts. What are rates that are not likely to be affected by a federal interest rate hike? Existing mortgages. So if you already have your mortgage, that's not going to be affected as long as it's fixed. Existing car loans and federal student loans. So anything that's already existing that you're paying interest on, those will not change. Taking a look at the FOMC schedule. So, of course, we are at the very first of 8 meetings this year. The next one will be in March, towards the middle and end of March, followed by one in May, June, July. Then they take a break in August for recess. Then we have September, October, and then December to finish it out. So what will it look like? Well, one of the more important things is, what are the FOMC voting members going to look like this year? So last year, we had a couple more hawks I want to explain something to you guys. So you have board members, right? Like Jerome Powell, Philip Jefferson, Lisa Cook, Lael Brainerd. They always get a vote every single year. Then you have the presidents of let's just say the St. Louis Fed, the Dallas Fed, the Philadelphia Fed. The only Fed president that votes every year is the New York Fed president, which now currently is John Williams. The other 5 rotate, or the other 4 rotate and alternate. So this year, we got more doves in the FOMC that have a voting power versus what we did last year. So the newcomers include Patrick Harker from Philadelphia, Lori Logan from Dallas, Charles Evans from Chicago, and Neil Kashkari, the Fed president of Minneapolis. Now, there's an asterisk next to his name because he has flip-flopped. He's went from dove to hawk to dove to hawk. So just some background on the ones that are not up in the air. So Patrick Harker from Philadelphia, known as a dove, he wanted to pause after the terminal rate came in at 3.4, and he warned of the Fed over-tightening the markets. Then you have Lori Logan, which is the Fed president of Dallas. She is also considered a dove. She was extremely aggressive with quantitative easing after the pandemic, when the lockdown started. So just to kind of put it in perspective, what she was about to, so the amount of money that she had to disperse in 6 months, she did that in 1 month. So she's very aggressive with QE. And she also came out and flat out said, if the economy needs it, no matter what the inflation is, no matter what the monetary system is, Fed should and can provide liquidity. So she doesn't care if we're down. She doesn't care if inflation's high. She doesn't care if unemployment's low. If the markets need liquidity, the Fed will provide it. That is her stance. And finally, we have Charles Evans, the Fed president of Chicago. He is actually a hawk. He is okay with over-tightening. And unemployment is of no concern. And so if we're sitting at 5-6% unemployment, and we're still not at that 2% terminal rate or the 2% inflation rate, then he's okay with continuing to tighten. So Robin, how much impact do you think these new voters are going to have on the direction the Fed is going this year?
I mean, I'm not inside the room, so I don't really know, but it sounds like a little bit more dovish is coming in, right?
Yes.
So, I mean, if that's the vibe, it's also time for we're getting towards the cap of interest rate hikes. You know, the target range is 5%, right?
Yep.
Or 5.5%, I think.
5.1, they said.
Yeah. So somewhere between 5 and 5.5% is where their target range is. And so, you know, there's not much left. It's only 1%. We're at 4.2 right now, right?
Yeah, we'll be at 4. No, we're at 4.5, I believe.
Okay. And then we're at 4.2. It's like it's a range. It's like 4.2 to 4.5. So anyways, right. I think we're coming to the end. As inflation is coming down. The job market is slowing a little bit. It depends on what exact metric you're looking at, but you know, there are layoffs. The median wage is not growing as fast as it was. There are a lot of jobs for every person, but you could equate that to retirements as well. So, you know, there is a lot of evidence to say that the mission that they're trying to accomplish for raising interest rates is working, right? And so, I don't know. I think we're at the end. We got some new people coming in on the Federal Reserve meetings or presidents, and they seem to be more dovish, as you pointed out. So I think we could, second half of 2023, we could be super bullish, right?
You think QE is going to start?
I don't think they're going to reverse. I don't think they're going to start cutting, but I think a pause in the next after the next like meeting or two. And then after that, maybe something happens globally. Maybe there's some sector that's in trouble and they start quantitative easing, basically injecting capital into the monetary. And you know what happens when you turn the money printers on. Real quick, before we bring a guest on, we do have a lot of new people here. So once again, if you're new, say hello. We'd love to give you an hola back at you. Also, Crypto Music gifted 10 memberships. So big shout out to you, Crypto Music. Thank you so much. Good to see that you guys are giving to the community, not just to us.
This is the most giving community.
Oh yeah, by a mile. Now, we got Tricky Nikki, A.E., Basil, B.O., Zachariah. We got Sun God. We have Andre S. Philip, Michael Castillo, Hovan. We got Ryan, Michael K. Pranjanga. And then we got Nate Q. We got Darren, FL Sunshine, Discipline. To all of you, hola! Welcome to Sin City
Guys,
Crypto.
do us a favor, all right? If you like what you're seeing so far, a lot of time and research went into this. We have two great guests that we worked so hard and we had to pay $5.5 million for us to join them. Just kidding. But in all seriousness, if you guys like what you're seeing, share the stream on Twitter, share the stream to your friends. We got so much great content, and we're going to kick it off with our very first guest, Mr. Caleb Franzen. Let's go ahead and bring him in. Caleb, how you doing, my friend?
Guys, how we doing?
Good,
Yo,
man.
I'm doing well. How are you guys?
Good. We're super stoked to have you today. You were on our show one time a couple weeks ago, and we had an absolute blast, man. So much great info. So first and foremost, thank you so much for your time. We appreciate it. For those that kind of, we have a lot of new people in here. For those that kind of don't know anything about you, why don't you give them a little synopsis?
Yeah, sure. So I used to work in traditional finance. I spent some time in wealth management. I have my bachelor's degree in economics from UC Santa Barbara. And after I graduated, I went to work up in San Francisco at a subsidiary of BNP Paribas called Bank of the West. I did that for about 2 years as a commercial portfolio analyst. So I got kind of this, 30,000 foot perspective, if you will, of how banking is conducted. So I got to see, our real estate division, our technology division, our healthcare division, our agricultural division, every which way, right? So that was pretty interesting for me. It was kind of a blend of like a risk management type position, but I got to see some deal flow, all that kind of stuff. So it was interesting. I ended up quitting that position in September, October 2020 to start kind of sharing my unfiltered thoughts on macroeconomic conditions, the markets, this, that, and the other, crypto. So I started my newsletter in May 2021 called Cubic Analytics. It's a free newsletter where I'm talking about the macroeconomic conditions, the stock market, and Bitcoin. And then I share my thoughts on Twitter with, I think we're around 25,000 followers on there. So, growing like crazy and having fun kind of spreading my message. So that's a little bit about me.
Amazing. And guys, if you want the free newsletter, there is a link in the description of this video. Make sure to go click. It is free. So nothing like getting great content from a great person. Caleb, I want to jump right into the CPI inflation numbers from last month. And so the CPI, the headline print came in at 6.5%, which is, as you can see here, so Robin termed a new thing, ascending stairs. These are descending stairs. That's Robin's patented...
my TA call right
his
there.
TA
man.
call, yeah.
It's
descending stairs.
We've been in an ascending stairs pattern all month.
Now we're in descending stairs.
I'm not the TA guy, as you can tell, but
we've been in this descending stairs since June. And then on the right here, we have core inflation. I think that's what the Fed looks at more closely, right? But let me ask you this, Caleb. Do you think inflation has topped? Like, are we ever going to see that 9.1% again or anything even close?
So I do think inflation has peaked. In 2022, I was, very cautious to kind of make that statement. But I think with the latest headline and core CPI data, this does really affirm a deceleration in inflation pressures. I'm going to be very cautious with the words that I'm using because, these nuances are very important, right? So we've seen a deceleration in inflationary pressures. This doesn't mean that prices are falling. It just means that they're increasing at a slower pace, right? So this is very important to note. We also need to remember, right? We're not going back to pre-COVID consumer prices. We're just hoping to get back to pre-COVID inflation trends, right? So the Fed doesn't target some level of the consumer price index. They're targeting a rate of change in the consumer price index. And so, since we got that 6.5% print, we've seen really encouraging data in terms of let me say it this way, the disinflationary dynamics that we've seen, particularly in the producer price index. And then last week, we actually got the personal consumption expenditures data, which the Fed really likes to look at, which again is kind of reaffirming this deceleration dynamic. We're seeing in a lot of the different data points, whether we're looking at, we were just looking at the CPI data right there. You can look at something like median CPI, trimmed mean CPI. Those are both decelerating as well for the first time. If you look at in the PCE data, you can look at median PCE and trimmed mean PCE. These are also declining for the first time during this inflationary regime. So I think at this point, it's fairly safe to say that disinflation is upon us, but that certainly doesn't mean that inflation is gone.
Fair enough. Rob, are you still in the camp that inflation has peaked out? And I know we talk about this on the show all the time. And
as far as ever crossing over 9% again?
No, I'm saying.
I mean, like in the short term?
Enough for topped out to the point where, all right, we go through another QE cycle.
Yeah, no, I think 9% was the max. And, there was a lot behind it. It was not just one factor. I mean, you had the money printer. You had people just sitting at home, not going to work. You had the helicopter money that we had with the Fed, with the stimulus checks. You had the supply chain. You had the shutdown abroad. You had the Ukraine war. And all of those converging factors seem to kind of coalesce in June of last year at the peak when we hit 9.1. Who knows what's in store for the future, but I don't think that we'll see anything even close to 9. If we were to get a bounce, I mean, history has said that inflation will bounce. It will come down and then it'll kind of shoot back up because perhaps maybe the Fed will over adjust on their on their hopes that inflation is down for the good. But
well, JP said multiple times, we're staying the course. We don't care.
But here's the thing. It's also not just the Fed either. It's also the markets. And so as the markets feel comfortable that, inflation is down, that the government and the markets are stable, they're going to pile back in, driving up costs as well. So, if there's a run on demand, if, we're seeing that was it iPhone sales were down like 30%? And
no,
but they've just incrementally year over year have just crushed it. They just crushed it with their sales, and they're a good indicator to see where people are in technology because most people will buy a smartphone before they buy a new computer.
How much dispensable income people have, and we're actually going to get into that as well.
And, so for me, it's just like. I don't know, man. I think the market's gonna get really excited, almost as excited as our chat is because our boy Redman dropped a $10 super chat. Jimmy threw out 20 gifted memberships. He's trying to one up crypto music. I see y'all over here battling in the chat.
Guys, if you think inflation has peaked, put a 1. If you think inflation has not peaked, put a 2 in the chat. Now, inflation is just. I'm going to move this.
No, go ahead.
Inflation is just one factor the Fed looks at. What's another factor? Employment. And Caleb, you tweeted something about I believe it was JOLTS, right? And
yeah, that's right.
We're going to pull that tweet up, but here it is. Unemployment rate still at that 3.5 level, which they call this a tight labor market, which is kind of gives the Fed more runway to say we can continue hiking. And if you take a look on the right, you have labor force participation. That giant gap in the middle, that is split. The pandemic split that, right? So on the left is what it looked like pre-pandemic. On the right is what labor force participation looked like post-pandemic. And so is any of this, how does this play into the Fed's decisions, Caleb? Is this a good sign? Is this a negative sign? What are your thoughts?
Well, fundamentally, it's a good sign, right? We want an economy that's strong with a low unemployment rate and a strong labor force participation rate. The labor force participation rate, generally speaking, I actually think is somewhat of a more important signal than just the unemployment rate. And it's really important to contextualize both of them together because they have a direct relationship. It's important to note, though, that basically since the financial crisis and the Great Recession, the labor force participation rate has been trending lower consistently over time. So from my perspective, it started to increase a little bit under the Trump administration, and then COVID happened, right? And so for me, I don't necessarily think that we're going to get back to those pre-COVID levels or trend higher thereafter. One thing that is important to look at is something called the prime age labor force participation rate. And I believe off the top of my head, that's for, people within the workforce that are between ages 24 and 55. So exactly as it sounds like, right? These are the prime earners in the US economy and the prime working force of the US economy. That number right now is at 82.4%, basically in line with the pre-COVID level, slightly below it, but nonetheless, it's recovered much stronger than the aggregate labor force participation rate. And so in all likelihood, the weakness that we're kind of seeing there is probably due to just kind of demographic trends, right? You have the baby boomer generation, 10,000 people are retiring every day for the next 20 years, some crazy statistic like that.
That's insane.
So for the Fed, yeah, it's absolutely nuts. And fun fact, during my first wealth management internship, I had to do kind of some data on the baby boomer generation. And that was one of the things that I came across. And I was like, oh my God, there's 10,000 people retiring every day for the next 25, 30 years. This is crazy. So tying this back to the Fed, right? It's always important to note, we've seen the Fed over the course of the last 18 months be primarily concerned with, with inflation dynamics. But it's important to note that the Fed has a dual mandate for maximum/full employment. And the second one is price stability. So right now, as it pertains to the labor market, it's pretty clear and unequivocal, at least in my perspective, that we have maximum/full employment. We have a 3.5% unemployment rate. There's only been 6 months since 1970 where we've had a 3.5% unemployment rate. I think all of them have come up in the last 5 to 7 years. So historically, This is very unique and a rare signal to have a 3.5% unemployment rate. It's historically low, right? And so tying this back as well into the JOLTS data that we got this morning, JOLTS stands for Job Openings and Labor Turnover Survey. And basically what this did is it showed that for the month ending December 2022, we had 11.01 million job openings, but estimates were projecting 10.3. So this was a massive increase relative to expectations and a massive increase relative to the November data, which as I'm showing here was 10.4 million. So,
and I got it pulled up, by the way, Caleb.
Yeah, I can see it on here. Thanks for grabbing that because this chart is super important to kind of contextualize, right? Like if we look back over the course of the last basically 18 months, we've had a historically elevated job openings level, right? And so someone commented under this post and said, isn't it a bad thing that we're seeing job openings increase? No, it's actually a very good thing for the fundamental economy. As I say here, during recessions, companies stop hiring and they're going to reduce their available positions. But during booms and economic expansions, companies hire and increase available positions in order to meet consumer demand. So all of a sudden now with 11.01 million job openings, employers are looking to expand their labor force right now, which is very contrary to the headlines that we're seeing with all of the layoffs in tech and so on and so forth. So we're getting a lot of strange and unique signals overall in the labor market, but it's important to contextualize, right? Like this is showing us how strong and resilient and dynamic the labor market is right now. It's very unique.
Amazing. And someone asked, how do we follow Caleb? Well, you can follow him on Twitter at Caleb Franzen, or you can subscribe to his Substack, his newsletter, Cubic Analytics. That link is in the description of this video.
You referenced headlines. One of the things that I follow particularly close is space, the space race, bro. I'm a big fan of astrophysics, and anyways, so we had some astronauts. Anyway, so normally here on the show, if you haven't been paying attention, if you haven't watched the show frequently, we have Robin's story time, and I like to go in and have and tell a story, something usually not at all related to crypto. But today's story time is actually brought to you by Kamala Harris. So Kamala Harris is she's really good at telling stories, particularly to little kids, 11-year-olds. She has a way with words. So without further ado, we're gonna bring in a Kamala Harris story time and have her Oh, there it is. Yes. Gotta love it.
Okay.
Oh no, Rocco, what happened?
Bob and Doug returned to the Kennedy Space Center. They suited up, they waved to their families, and they rode an elevator up nearly 20 stories. They strapped in to their seats and waited as the tanks beneath them filled with tens of thousands of gallons of fuel. And then they launched. Yeah, they did.
All right. What? Okay.
Told a story like it was a group of 11-year-olds, huh?
You know, there was a video of the Prime Minister of the UK. He was in his car. It was like, okay, guys, so here's what happened. Now, all right, Caleb, let's get back to crypto. It's some comedic relief, but let's get back. You and I were on a Twitter Spaces, and I had said Bitcoin has never been through Fed raising interest rates, to which you corrected me and said, no, in 2016 they did. I guess I should have worded it like to the extent we have, but you're 100% right. Do you talk us through that for a quick second? Like, how did Bitcoin react as the interest rates were going high? Obviously, we can't compare it. This is historically fast interest rate hiking, right? And monetary tightening. But what did it look like? Are there any comparisons you can draw from 2016 and now? Any differences? I don't know if you have any charts or metrics you want to show, but I'll kind of just leave it at that. And yeah.
Yeah, it's such a great question because analyzing interest rates is really a core kind of component of my approach to analyzing overall market conditions and asset prices. And so, in entry-level finance and economics courses that you end up taking in college, if you go down that path, one of the things that you learn is how to calculate it's called the net present value of any asset. And the way that you do that is it's a very simple math function, right? But at the end of the day, basically what it boils down to is that there's typically an inverse relationship between interest rates and asset prices. So as interest rates go up, all else being equal, the price of an asset should go down. If interest rates go down, all else being equal, the price of the asset should go up. And so traditionally, during periods where interest rates are rising, that typically creates headwinds for asset prices. And when interest rates are falling, that creates tailwinds for asset prices. So that's very important to understand. And so there are periods where interest rates can be rising and the present value of any given asset could actually be rising. And there's some math that you can kind of back into with that, but it all depends on one primary thing, which is future cash flows. And so if we kind of rewind to 2015, 2016, and then the period thereafter, the Fed started raising rates by 0.25%, and they kind of forecasted to the market that was their plan to keep doing that going forward every other meeting. And so the market had an ability to kind of digest and see where the market was going in terms of Fed policy. And so even though we were having these 0.25% rate hikes, very steady, very consistent increases, and very small, right, at the end of the day. What happened was, not to get political, because this isn't a political thing, but during the Trump administration, we had a massive deregulation in terms of the business environment. So corporate taxes were going up, and we also had, or not corporate taxes, corporate profits were going up, excuse me. And at the same time, we had corporate taxes being cut and individual taxes being cut. So from my perspective, this is a massive boost in fiscal stimulus. And during that time, like I said, we saw business profits go up and we saw individual incomes rising at the same time. And so during that period, even though interest rates were rising, asset prices were able to do extremely well, right? Look at the annual returns for the S&P 500 in 2016 and 2017. Obviously, in 2018, things got way too far ahead in terms of monetary policy. The Fed started reducing its balance sheet, so on and so forth, and the markets finally caved, right? After all of that fiscal stimulus had started to wane off. And so, in 2022, we had this massive increase in interest rates, but we didn't really have nearly as much fiscal stimulus as we had in 2020 and 2021. So if you think about rate of change dynamics, we were no longer in an environment in 2022 where we could overcome the rise in interest rates. in addition to the fact that interest rates were rising at a historic pace, unlike in 2015 and 2018, where we were just steadily climbing up. We were talking about that stair-step behavior, right? Going up the stairs,
Ascending
very
stairs.
slowly, as a technical term, right? And so, the environment in 2022 was very different. And so, there's almost no comparison to it, especially in Bitcoin's history. And the only comparison that we really do have is like the late 70s, early 80s. So we really have to go back, 40 plus years to get to an environment from a interest rate perspective similar to today.
Okay. What are your thoughts on that, Robin? Do you think did you kind of agree with Caleb as far as, hey, the past year and a half of interest rate hike, it was like so sudden and we didn't really know what to expect until like mid-year versus 2016 where we kind of knew how it was going to go? Or do you think it's just more than that? It was maybe the war, maybe the lockdowns as well. What are your kind of thoughts?
I think we all know what the Fed is going to do. They just address it way too late. Like we knew that when they cut interest rates to zero, that it was only going to last for so long. And I think we all assumed they were going to raise interest rates sooner than they did, but they didn't. They kept saying that interest rates were transitory or that inflation was transitory. And then they started raising interest rates just way too late. So for me, if you're asking, do I think the same is going to happen? Absolutely. I think they're going to keep raising interest rates to a point to where it's a little too late. And then by the time they decide to cut, probably going to do the same thing. I mean, history is just going to repeat itself, especially when it comes to the Fed and their monetary decisions. I don't see us breaking course from that anytime soon.
Yeah.
Not like they wised up on their time frame.
Guys, we are 5 minutes away from the Fed rate hike announcement and 35 minutes away from the press conference. We'll be covering those both live. Now, I want to pivot, Caleb, before we bring our friend Magic on. I want to pivot to Treasury yields. And another tweet from you. The 3-month Treasury yield is now above 4.7%. Meanwhile, the effective federal funds rate is at 4.33%. After tomorrow's rate hike of 25% likely, the EFFR will be at 4.5. This means that the bond market is pricing in a 50% chance that the Fed does another 25% in March. Explain it to me like I have no idea what the hell I just read.
So, in a lot of ways, there's a recursive relationship between the bond market and the Federal Reserve, right? Because the Fed isn't able to change policy on a daily basis, but the bond market is able every second of every day to price in new economic data, Fed policy, whatever the case is, and kind of skate to where the puck is going. And so a lot of people have been really kind of tied up and concerned about the relationship between the 2-year Treasury yield and the effective federal funds rate. But right now, and that was something I was pounding the table on back in February of 2022, telling people to pay attention to that relationship. And basically saying buckle up for a historic tightening cycle. And that's exactly what we got. And so right now, personally, I think it's a little bit more important to be watching this 3-year Treasury yield because basically where I'm seeing it, it's basically at 4. Yeah, excuse me. Yes, 3-month Treasury yield, because right now that's basically at 4.7%. So for me, that's the bond market is telling us, it's kind of giving us an upper bound, if you will, about where the Fed can go. Right. So the Fed is really jawboned about getting to a terminal rate of 5% or above 5%. Right now, the 3-month Treasury market is telling the Fed, yeah, you might be able to get to 4.7, and that's as far as we're going to let you go. And so, like I said, today, after the likely increase of 0.25%, the effective federal funds rate will basically be, 4.6%, let's just call it. And the 3-month Treasury yield is at 4.7%. So we basically have the bond market is giving the Fed another 0.1% of wiggle room to raise rates, right? So it's just it's a modest increase. So, we have to listen to what the bond market is telling us. And right now it's telling us that we're at the very tail end of the tightening cycle. And, whether this is the last rate hike or not, getting one more after this might be kind of the final nail in the coffin, if you will.
That's intriguing. Obviously not a lot of people really understand the whole how the relationship with Treasury yields, like the bills, notes, and bonds, are with the effective federal funds rate. And I'm going to ask this question to Robin before we move forward. Do you think there's any way the Fed hikes more than, let's say, 5.5%? And I'm not even saying
in totality.
In totality,
I think. I mean, you can't forecast global events, and we had a pretty quiet 2019, and ever since then, it's like you got to expect 2 or 3 major global events to happen. I don't even want to try to speculate what those could be, but something is going to drop. Now, will it affect the U.S. markets to a point to where it scares the Fed into saying, "Hey, we need to drastically cut interest rates," or vice versa? Perhaps, but barring a black swan event that shakes everything up, I think 5.5 is the max, man. And at some point, things are going to start breaking. Whether or not we go into that deep recession, you're gonna maybe, I don't know, man. I just don't think it's possible, bro.
There's definitely a limit to how high they can go until the debt servicing gets too expensive and the economy just completely crumbles.
Right. It's only so the meeting is supposed to adjourn here in a minute, or actually right now.
Yeah, we should get an announcement here soon. We got our eye on this breaking news here.
Real quick before we jump into it, I just want to give a quick shout out to our some of our new people in the chat, and then we'll start covering the press conference. And so if you're new here, say hello, so that way we can drop an hola back at you. And we have Bearish Bull, Quilly, Official K. We got Xerox, Bruce. Jerome H. Powell is in here as well. And then we got Eddie, Ham City, Angry C, Jade's Blaze. We got Sean A, Nick Harper, Junior Giles, Infamous, Quilly, The Undertaker, CryptoCon, and Chantel NZ from New Zealand. And then hola! Welcome to Sin City Crypto.
All right, guys. Breaking news to no one's surprise.
There it is.
0.25 point to 25 basis points. That is what they're raising. And so, as everyone expected, as the CME expected. And so, damn, Undertaker, calm down, bro. It just literally pulled up right now. Okay. All right. Let's bring our fourth or our second guest on. Let's go ahead and bring on Magic. Magic.
Hey, hola. I think that's how we're doing it, right?
How you doing, my friend? Hey, Magic, Caleb. Not sure if you guys have ever worked together, but Magic, meet Caleb. Caleb, meet Magic. 2 of our favorite guests that we have on the show. So we appreciate you guys joining us. Magic, let me ask you. Well, first, I'm not going to ask you if you're surprised at the 0.25 basis point rate hike, but do you think this sets the tone moving forward? And if you were to forecast, what's the next one going to look like? When are we going to get a pause? I know we're going to have to wait till Jerome Powell speaks at the press conference, but what does this tell you that they stuck to the 25, and what do you kind of forecast moving forward?
So 25 was expected pretty heavily by everyone. Me personally, I've been in the camp that we were going to get 25 and we're probably going to get another 25. It wouldn't surprise me if they did pause at this point, but I think another 25 is something we could expect, and then a pause. And I don't think we see any rate cuts or anything in 2023 just yet.
What about you, Caleb? What are you forecasting moving forward, right? We're going to see another one at the next meeting. Is there any chance of a pivot this year? What are your thoughts if you were to forecast?
So, yeah, 25 was definitely expected today. My personal opinion is that they'll do another 25 in the March meeting, maybe one more after that. But I wouldn't get super locked into that thesis because everything's going to depend on inflation dynamics and how the labor market kind of continues to evolve. So, one of the pieces of language that came out here, I'm trying to find it, is that ongoing, in quotes, ongoing rate hikes are still appropriate. So clearly the Fed is forecasting and telling us that, this is not the last one based on their expectations as of right now. And so, if I was a betting man, I'd say that we will probably get another 25 basis points in the next meeting, which I think is sometime in early or mid-March. Yeah, I mean that's pretty much it. After that, I don't really know. So it'll be interesting to see how things shake out. But I certainly don't think that this was the last one, even prior to the language that we just got from the Fed.
Right. And now we do know there's a lot of volatility during the press conference, but Magic, what's Bitcoin doing? Like, is it reacting to this expect ongoing increases? Let's take a look at a Bitcoin chart, if you don't mind.
Yeah, no problem. I've had a few ideas on what I was looking for. We kind of lined it out this morning, and it's fairly simple here. So for me, this has been a really, really easy range to navigate. You've got your previous week high here and your previous week low. And so realistically, you can kind of map everything off from there along with your September high. Resistance here. For me, I'm really looking for this push up into this resistance personally. That's where I like to get ahead short. And the main reason being is that it offers up the best possibility to potentially trap some traders, and the DXY as well coming into, I wouldn't say macro support, but pretty high time frame support. So kind of gives you that inverse correlation there where everyone's looking for a pullback. I think with 25 basis points, people could get excited. They're like, well, maybe we pause the next one, get traders excited up at resistance. That's what I'm after. That's been the move I've been waiting on all day. And if I don't get it, it's okay. I'm just not going to trade it. But in terms of order flow, it's been absolutely abysmal today. We were looking at that earlier. We have a live stream on Wednesdays where we do like the New York session, and you can see that we're not tracking this based on time. We're tracking it based on the millions coming into the market. So your delta chart. And you can see that these are taking 16 minutes, 10 minutes, 18 minutes just to fill out a 5 million candle, which is atrocious in terms of time. So we finally got some action here as they released the rate hike. You can see it was a quick move up in to some low time frame resistance still. And now the delta is shifting up to where people were buying. You can see delta's pretty high. And now you can see sellers are trying to step in. So it wouldn't surprise me if we don't get that move up. I think everyone, including myself, has been kind of eyeballing that area. So if we don't get it, the easy trade's just not going to come today, right? So for me, no positions on the day, just waiting to see if it comes into either alert for me so that I can make a decision, I guess.
Let me ask,
I personally favor a pullback from here, but go ahead.
Let me ask you this question, Magic. What are you, okay, so let's say Jerome Powell speaks and he's super hawkish. Well, what's a support level on Bitcoin where you're like, all right, if it breaks through this, then something crazy happened. Like if we were to see a super hawkish Fed in a press conference, where should we look to buy? Where is Bitcoin's next stop down as far as support?
So realistically, 22,407 is actually a level that was generated in the second half of 2020. It's a 6-month average of price from that move up. So that's what I've been working off of for this area. So 22,407 is a big area. If you lose this, you can see this was a really fast move up. And if we go back to here, you can actually see what's called a single print there. So some people will call these volume gaps. You can just quantify them a little bit easier if you were to zoom out a little bit. And we got to go quite a ways back for it because we've been up here a while. But it'll give you the exact levels of where price basically is going to break down structurally. So it makes it really easy for you to come in and start mapping it out. And you can see it's right in here on this candle, and you just start zooming in and you can see it. So you can get this on Exo charts. You can also get it on ATAS. ATAS offers free crypto in terms of order flow. It's not as clean, but it's good. You can see this is all one big single print, meaning if you lose about 22,400 and you start working your way into this single print, you're probably going to fill the whole thing out until, I would guess, about 21,000. So 22,407 is really the most important level on the chart right now. And if you don't swing fill that level, if it's reached something like that, then yeah, I'm looking all the way down to 21, which correlates really nicely with, where we were setting up previously. And if you were to do something as simple as just turn on your pivots, because those are, again, just averages of price, you can see that we've been trending above our weeklies for quite some time, which is a very aggressive trend. And it doesn't happen that often. So you have not tapped them for several weeks in a row. These do hit it usually about an 80% hit rate. So when you trend above them this hard, you would expect potentially a pullback to some kind of a mean reversion. And if you look at the monthly on January, your average is coming in closer to like 21.2. So that's the appropriate way to kind of use these. So if you start breaking down from here, I'm going to be targeting 21.2, but realistically probably looking for support somewhere in this box between 20,434 and 21,088. Give or take a few dollars.
What are your Caleb? Are you seeing the same thing on the charts? Are those the levels you're looking at as well? And then maybe let's take a look at what NASDAQ and the traditional markets are doing?
Yeah, I'm taking a little bit more of a zoomed out approach right there. I've seen some of those similar levels when I look at like, 1 hour candles or things like that. But for me, the real line in the sand, I've just been referring to it as the 200-day moving average cloud. So we got the exponential moving average right now trading at 21,241. So that kind of lines up as some form of support, as well as the simple moving average right now is basically trading 19,710. So for me, that kind of full range there, basically a $1,500 gap is kind of the overall dynamic support range that I'm seeing. We're trading above it really for the first time since basically December 2021. So, we got rejected on that level perfectly back during that mega rally during March. We haven't retested it since March of 2022. So we're above it now for the first time. This is a great kind of dynamic support and resistance level. We're above it now. So for me, that's valid support. As long as we stay above that line, I think momentum is in favor of the bulls. So,
And I'm going to know Bitcoin did something it's never done before in its history. 4 straight weeks to start the year green. So 4 weeks in January, it was all green. We're up close to, I believe it was close to 40% on the month, which was one of the best starts we've had. I want to pivot to here's what's changed.
Real quick though, real quick. We did reference the FOMC meetings. So obviously we have ours today, but here is the calendar. The next one's going to come up on March 22nd. And then we're not going to have one in April. And so we'll have a little bit of a gap there. But you also have 2 central bank meetings as well going on tomorrow. So the EU and the Bank of England are having their meeting to decide their interest rate as well. We know that the EU had not changed theirs for a while. They just recently raised their interest rates there. So we'll see. We did have a big drop down in their inflation as of recently, and a lot of that has to do with the energy prices, especially with natural gas. So curious to see how that'll shape up, and it should also affect the markets. This is more of a question mark than here in the States as far as what the central bank is going to do. So.
Yeah, and typically these other central banks follow what the U.S. does, but things are a little different in Europe, and so it'll be interesting to see what they do. But so the Fed statement has been released, and you can see what's crossed out is what they've changed. And so they said inflation has eased somewhat, but remains elevated, and they striked out reflecting balances. They striked out talking about the war and how that has upward pressure on inflation. The committee is highly attentive to inflation risks. They changed the rate to 4.25 to 4 3/4, or 4.5 to 4 3/4. So now we're at that 4.5 to 4.75. Their terminal rate was 5.1, which is what they've said. And those are the biggest ones. And here's the change, guys, that I talked about: the change in who gets voting power at this year's FOMC. So yeah, and I'm just going to take a quick look at CoinMarketCap. Bitcoin crypto is actually up on the 1 hour. Everything looks like it's up about 0.5%. What Magic? Do you have a stock chart, like a Nasdaq chart or a Dow Jones chart that we can maybe take a look at?
Yeah, the stock markets were down slightly going into this, and the Nasdaq has flipped just up slightly as well.
I know the Dow was down close to 300 before we went live. So what's that kind of looking like?
So I actually look at the SPX quite a bit, to be honest with you. I'm an S&P 500 kind of guy when I'm looking. If I'm charting it against for crypto, I tend to lean towards like the ES or the SPX. So in terms of the SPX, you are actually at resistance. It's a known resistance. However, you're trending against all of your major averages. I don't use moving averages. That doesn't mean they're not valid. I use a different kind of average. I like horizontals. As you can see, this is your last 6-month average right here. That was our most recent support, up to your last year's average. Again, these are just basically pivots. It's a basic math, but it gives you a nice concrete level. You want to be trending above them, meaning that people are interested in the price above the average. And you're coming into this Q1 low in an old NPOC from Q3 that was left untapped, meaning that when we left the range, we never came back to finish out that auction, or however you want to word it, right? So if you get back above this level, it's actually a fairly big deal on like a higher time frame. So you are coming up to resistance. So again, as I was stating, where the DXY is coming into potential support, Bitcoin's looking like it might want to try to jump up and hit some resistance. You've got the SPX all coming into resistance here. As a trader, it doesn't mean it's an automatic short, but for me, I'm looking at it as, if the opportunity is there, can I get this push into this level, take these local highs, and get a good setup for the downside? Or should I just continue to hold my long positions? I think that we have further upside in the coming weeks still, so I'm not going to cut any longs that I've taken on Bitcoin. But I do think that if, roughly 41.14 to 41.37 is claimed, this quarter one low from last year's rally, you are probably looking up closer to $4,400. I think at that point you could get a substantial rally into like this gold pocket, and that's really just there to kind of give you an idea of a landing zone for price. So, there are some things at play. Now, if you start breaking down from these levels, then yeah, you're just remaining range bound here, and you really haven't done anything. The most important thing that I would say that you've done is, I know everyone's watching the trend line for SPX. Are saying that we broke the trend line. For me, I like to use regressions. I use very specific settings for myself, and I track them by time. And this is the 2022 regression. It's gotten things very well. It's not meant to be perfect, but it's been pretty good. You've got your back test. So until we formally break down and come back into this, I'm really not looking too bearish on the markets in the short and medium term. I would expect us to probably challenge these levels, though. I would like to see these local highs taken, get into these, fill this void in, and then kind of see what the data is when it's coming in. Like, is this a good short setup, or should I sit on the sidelines and let the market rally into the next resistance? So that's how I'm looking at it. I'm actually not too bearish on this. You've got a pretty decent setup. So for anyone that studies harmonics, Scott Carney, harmonictrader.com, it's free information. These are patterns that he's basically gauged reactions on. This is a shark pattern. You've taken the local high right here, basically, come back down to the 50%. The 50% is referred to as a 5-0 transition. And so when you get reversals off that 50% mark, which we can mark out real quick here so you can see what I'm talking about, it's actually a bullish continuation. So this flips from a bearish pattern to a bullish at that time because of that 50% interaction. You can see you've come exactly down to that level. That's also going to be your quarter four average. It's going to be your quarter one average for 2023. Your 6-month average is here for the first half of this year, and you're trending above all those. So until we're breaking back down and really kind of invalidating this, it's hard for me to be overall bearish on traditional markets as of right now. That doesn't mean it can't change. Obviously, anything can happen. But unless Jerome Powell comes out and says we're doing 50 basis points next time, no matter what, I'm not thinking we're just going to get absolutely nuked past this. It could remain range bound here, though. I mean, that would be the ideal play, is to remain range bound, get the short up here, trade it back into the range, and go from there. Trending moves are kind of. Go ahead.
I don't see JP coming out and saying, "Oh, we're doing 50 no matter what." Obviously, he did say ongoing, but I guess it remains to be seen. We are 15 minutes away from his press conference. We'll be covering that live. Make sure. I want to pivot from charts to, I want to talk about something that could potentially make the Fed turn the money printers back on. And so there is an issue right now with consumer spending, personal savings, and credit card debt. And from the things I'm seeing, the metrics I'm looking at, it looks like something's going to give soon. And so let's first take a peek at personal savings. This is from the Fred. Personal savings, you take a peek. That peak there was in 2020. And this is on a per year basis. We haven't been this low since you can argue the close to the 2008 recession. Now, what about consumer spending and credit card debt, right? We know inflation's been high. So how are people spending their money? Obviously, we expected consumer spending to go up because prices go up. But look at the credit card debt on the right chart there. Credit card debt is the second highest currently we've seen over the past 20 plus years. One more thing I want to show is this. These are commercial bank rate interests on all credit cards, and this is at an all-time high, over 17.5%, 18%. You also have this, the delinquency rate on all credit card loans. You can see that thing had a big curve up and it's pointing upwards. You can see what credit card delinquencies look like in the last recession back in 2008. So I'm going to ask you first, Robin, do you see this as an issue moving forward? Obviously, with high prices, people are going to their credit cards. And then now there's job cuts and people are getting laid off, and so people are not paying their credit card bills, right? And this is going to harm the banks. Do you think this is enough?
I mean, everything you just laid out is indicative of what you see in a recession, right? And the argument is not so much are we in a recession, are we teetering in it? I think we can all agree that we're at least in it at some point. It's just at what stage of the recession are we in? Are we coming out of it, or is this only the beginning? I think that's the big unknown. And you look at savings being obliterated. How can you save money right now? Yeah. As a middle class American, or even abroad, with inflation, it's really not any different abroad than it is here. If anything, it's worse. But the cost of rent, mortgages are still sky high. They have slowed and slightly pulled back, but they're grossly over the price they were going into 2020. And yet the median salary has not gone up. Not nowhere close to the level that we've seen the housing costs go up.
Well, salaries have gone up. They're just not on par with,
they're
inflation right
They're
now.
Grossly mismatched.
Real wages
there. And with housing being the number one expenditure for the average household, it's your biggest bill, and that you got no relief there, and you got no savings. Your credit card debt is growing across the board, and the interest rates are up. So it's literally a recipe. You have no savings. You don't make more money. Your biggest bill costs more, and now you're running up your credit card bills, which you're incurring more and more interest. Now, is this the peak? Will we see savings go up? We see, the median salary go up, housing prices come down. I think we're heading that direction. I don't think it's fast enough, though.
Here's the problem, though. Salaries go up, so do prices for goods, right? And so it's like a lose-lose situation. Caleb, I want to ask you, the picture I painted, are you as concerned as kind of me and Robin are? And do you think if we start seeing delinquencies at a clip that we saw back in 2008, Fed might have to step in like they did in 2008 and provide liquidity to these banks and bail them out? What are you forecasting, and are you as concerned as we are?
So I'm not super concerned right now, though there's certainly reason for caution, right? And so, when we look at something like consumer debt service payments as a percentage of personal disposable income, we're back above the pre-COVID level, but we're still at, I would say fairly low levels. We're basically below 6%. The number here I'm looking at is 5.75%. Whereas if we look at 2008, it was 5.99%. So, we're below that 2008 level, even though debt today is higher than it was in 2008, 2007. So that's pretty interesting to note. The thing that I am certainly concerned about is the trend in delinquencies. If you guys want to throw that chart back up again, I think it's super important to highlight this, because throughout history, what we typically see is that as delinquency rates are very low, usually they'll kind of stabilize around that level, as we saw there. And once they start to trough and trend back higher again, essentially reaccelerate, that process doesn't typically stop, right? So if we look at that kind of level there in the mid 1990s, right? We had that massive downtrend in the early 90s. We started to trough, and then we didn't stop, right? We just continued to trend higher, and then we basically stabilized for several years until we got the 2001 dot-com burst. Now look at what happened in 2007, basically 2006. We hit a local trough, and then we started to reaccelerate higher. That trend did not stop once it started. Look at 2014, 2015. It was a much more modest increase in reacceleration, but the trend was what? Delinquencies were rising. Now, what are we seeing today? We're seeing that same exact kind of trough dynamic and reacceleration higher. So for me, my base case in 2023 is to see delinquencies increase. And this isn't just going to be for credit card loans. This is going to be for auto loans. This is going to be for mortgages. This is going to be across the entire spectrum of commercial loans. So this is going to be very important to watch going forward.
Magic, what are your thoughts, right? Obviously you can tie, we talked about personal savings are down. And, there was a relation between, there's a reason in 2020 when everyone was getting those $1,400, $2,000 checks that a lot of that was going into crypto, right? You're locked in your house. You can't travel. You can't take an airplane anywhere. Let me degen in a ship. Let me degen in a Doge. How do you see?
Dogecoin to the moon.
Yeah, Doge to the moon. How do you see that personal that personal savings chart of how down it is? How do you think that's going to affect cryptocurrency? Like, do we need to see people's savings come back up, or at least disposable income go back up before we could see like another bull market or a big rally in crypto?
I don't necessarily know that I would equate it to that. It certainly helps when people have more money. It doesn't help with inflation necessarily unless they are actually saving it. So I think we would like to see that come up because, as you were alluding to with like delinquencies and stuff, that's definitely not a good thing. And I think that the housing market is a really big one for me in terms of you start seeing further delinquencies in that. And, this is something I've discussed with Gareth on the last show where we say the housing market really is important. Like if that goes, I mean, in theory, everything else is kind of probably already gone with it. So I wouldn't want to see that going. No, I would like to see disposable income come up a little bit. And at the same time, you want consumer goods to come down, which sometimes those don't go hand in hand. But yeah, I mean, I don't really think it's necessarily in order to have a crypto bull run. I don't think that's going to drive price back to 69K just because people are saving a little bit extra money and they're getting, an extra $1,400 here and there. It certainly kind of adds to the narrative of like a hype train, but you have to remember that people that were pushing that market up weren't just like the average degen. You had investment firms that we thought were smart money and they weren't. They were, just YOLOing entire portfolios worth billions apparently. So, I do think it'll take more than just people saving a little more money to bring the crypto market back, unfortunately.
What do you think, Rob? Do you agree with Magic here, or are you kind of on my side where I'm drawing a symmetry to people having excess money, people pouring money into crypto? You think that matters less, or are you concerned with the savings rates going down and people's disposable income going down?
I think right now we're not going to see regardless of what happens with the broader markets, and I know everything points to a one-to-one between risk-on assets, the general market, tech stocks, and crypto. I just think right now there's a big stain on crypto's reputation. I just don't see the retail piling in just yet. And not to say that we can't see a run up, a small rally, but if we're talking about bull market, getting back up to $40,000 Bitcoin, $45,000 Bitcoin, I think right now we just need to distance ourselves from this contagion to a point to where people kind of start to forget about the Celsius, the FTX, the Voyagers that are going under, because right now the temperature in the room ain't good, and so that's what I personally think. And whether or not people's savings, people start spending, people start to invest a little bit, I think crypto's gonna lag behind the rest of the market if it does rally sooner, just for the simple fact that people have a bad taste in their mouth when it comes to crypto.
All right, let's take a quick. Go ahead.
Sorry, I was just curious.
No, you're good.
Do you think
Go
we
ahead.
need regulation for that to happen? I mean, that's kind of my opinion. Is you have to have regulation really.
I think regulation or time, one or the other, because we've seen from other market cycles the same thing has happened before. Whether you had your BitConnect frauding people, so fraud in our space is not new. And mismanagement of funds are not new. Rug pulls are not new. It's just done on a more polished, hey, there's a commercial on TV level. And, that is what's scary, is that it's more mainstream. But at the end of the day, it's kind of the same thing. You give it enough time, people will forget about it. The same thing with the housing market. You give it enough time, people will forget about it and they'll start buying houses they can't afford. And history will repeat itself. Now, if we get regulation sooner than later, say some kind of clear-cut regulation when it comes to CFI were to drop in the next 3 months, green light, let's go. But I don't know if Congress moves fast enough. And if we start seeing a rally out of the markets in the short term,
Congress definitely doesn't move fast enough.
Yeah. But you never know. It is at the top
of
their...
They can't even agree to keep the company
but
from going
I will
bankrupt.
say it is at the top of their agenda. So it wouldn't be the craziest thing ever if they did pass regulation, because it is on their agenda. It is a hot button topic. There are politicians. I don't think it's going to happen.
All we're going to hear till June, bro, is this debt ceiling thing. That's literally all we're going to hear about, and they're going to go back and forth. Republicans are going to say cut spending here. Democrats
there is a call to action. There is a people that are demanding accountability for what has happened with FTX, and I don't think that anything will get done in the short term, realistically. However, it would not surprise me if they actually get the ball rolling on regulation. It is a bipartisan issue, so it's not dependent on one side having the seats, and they just need to get it done. And what is the chat thing? You know what? Let's get a 1 and 2 in here, guys. If you think Bitcoin is destined, and crypto is destined for a rally this year, irregardless of what happens in Congress, put a 1 in the chat. If you think that we're going to trade sideways or perhaps test some all-time lows, if you're bearish in general, put a 2 in the chat. 1 bullish, 2 bearish. So I want to know what the chat thinks.
Caleb, do you have any thoughts on what they're talking about before I move on?
I don't know. I mean, I think I like what this idea of both time and regulation. I think I'd agree that the whole kind of charade of concerns around the debt ceiling and all that kind of stuff, just basically kicking the can down the road, is just essentially to stir up kind of a frenzy. I had my 78 or 79-year-old great aunt giving me a call, asking me if her bonds are safe and this, that, and the other. And I'm trying to reassure her, Aunt Mary, don't worry, everything's going to be okay. This is just, everything's going to be fine. Don't worry. So
there's no way,
this
right?
is exactly the kind of.
There's no way they don't raise a debt ceiling, right? There's no way they don't raise a debt ceiling, right? No way.
Look, I mean, it's not a non-zero chance, right? So there's a percent likelihood that it happens, but it's, in my opinion, like infinitesimally small, right? It's like, how do you even quantify how small of a likelihood it is? I can't. So all I could say is it's a non-zero chance, but pick as close as you can get to that zero bound, So that's my thoughts there.
Okay. All right, guys. So the press conference has not started yet, and we are keeping an eye on that. But before we hop on, I want to share a tweet from our friend Magic here, which, by the way, if you're not following Magic Internet Money.
Oh, here we go. He's taking a stand.
He is?
Yep.
All right. So let's listen to the Federal Reserve Chairman.
And real quick, while he's walking into the room, I'm going to give a quick love to the chat because we won't do it for a while. If you're new here, say hello so we can drop an hola back at you. We got Broke Yoshi dropped 10 gifted memberships. We got Don't Touch That Jut, Corey Wrights, Matthew Turnbull, Oxpence, Richard, Rashad Lewis. Hola! Welcome to Sin City Crypto.
All right, real quick, while he walks up. All right, so we had Magic. I was going to show your tweet. You said Jim Cramer comes out and says we're in a bull market by the dip, and on the back end, Michael J. Burry, who is the person behind The Big Short, he said so.
It was actually a retweet of Caleb, and Caleb had retweeted that, and right beneath it was Michael Burry, and I was like, you can't make this up. I've got the two guys basically pitted against each other. It was great. So everyone's involved, full circle.
All right, let's see what Mr. Jerome Powell.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Wow, the Dow Jones has it's gotten some of the losses back. So Dow was down 500 points. It's now at 235. I don't know about you guys, but that seemed a little hawkish to me. What are your just thoughts right off the bat, Magic? Was that more hawkish, dovish? Is that what you expected?
That's kind of what I expected. I didn't expect them to come out and, be like, we're doing 25 basis points and then not say they're going to steady the course when that's been the rhetoric all along. So I'd be curious, what kind of questions he gets and the answers we see from those. So,
yeah. Well, what about you? What about you, Caleb? Was that hawkish, dovish? What you expected? What do you think?
Yeah.
I think it's neither necessarily. I mean, 25 basis point rate hikes aren't anything that the market, necessarily can't handle. I mean, wow. I mean, the NASDAQ right now is just boosting off those lows here. I'm trying to see really quick, literally just like 6 minutes ago until now, the NASDAQ is up 1.4%. So I don't even know what he said in, 6 minutes ago that caused this to necessarily happen. Right. Yeah. So
right.
I think basically that's if I may really quick, I think the market is basically just giving Powell the kind of green light that, hey, if we got to do 25 for you guys to get inflation back down, let's do it. I mean, yeah, wow, this is pretty crazy.
I know now Dow is now only down 150 points.
Yeah.
Say Bitcoin put in a pretty decent trap here at the lows. I'm not going to lie. It was pretty clean on the order flow.
Can we see it?
You came to, yeah.
Can you share that for
real quick?
Yeah, I didn't hear anything that wasn't expected. His normal, hey, stay the course, 0.25, the target range, it's all the same, impacting families. So it's exact same verbiage that he used. Yeah, that he used last time. I think he might have emphasized the strong labor market a little more so than before. But other than that, everything seemed pretty much on par.
Yeah, that's kind of what I was expecting. So what happened was everyone got bearish as soon as he started talking. And if you recall, we were up here when we were kind of chatting about, what's the order flow saying. We were finally getting some action, and it had flipped over fairly bearish. You can see all this right here, the delta column. So you can see people are selling, right? And right about here, you get a huge washout. So this says the open interest is flat, but in reality, the candles are just coming in too fast for it to register. 12 million cut off, 9.4 million coming off, 5.2 million coming off. This is all just Bybit data. And then right here at the low, you can see that you now have a delta switch where positive buyers are coming into the market. And you can see open interest is increasing heavily. You're trading outside of the daily range. So when you see that, all you're looking to do is, okay, can we get back to the VWAP? And if we do right here, I want to see buyers coming in. And all you see are these little yellow boxes. You can see buying imbalances. So this is the market supporting the move above a major volume weighted average price. So now the trend is very strong. So this is a very good trend, at least to rotate the entire range, which it's already done very, very quickly. If you translate this to trading view and how you could have spotted the level for it, we actually went over it on the stream. Okay. So we were talking about 22,810 kind of being that level in between right here. And it's been a really great level to have. If you look at the daily, we have actually not closed beneath it. So you've come back down. You've effectively swung fail your local low right here. That's where you saw the open interest falling off as soon as you took this low. So you see people getting stopped out of positions, and then they reverse position and buyers enter the market. So this was actually a pretty nasty little bear trap. They did it right when he was talking too. So that's why I always tell people, like, sometimes it's important what they say, but personally, I'm more into the order flow, and that was a really good trade if anyone was available to take it right at a key level of support. And now I'm looking for this to push to 23.4 and probably 23.745 is the ultimate potential is where I want to see it go. But very, very clean in terms of what came in. So if you were watching this, it was really easy. Yeah. Yeah. But you can see these candles, the 5 mil. We were just complaining about time, how it was kind of boring. These candles are filling out in 2 seconds, 42, 35 seconds are slow. 1 minute's a slow candle now, and then 12 seconds, 24. So these are people pushing in. So the problem with a move like this is if you wait too long and you start FOMOing at the high of it, you end up being one of those guys, just like the people that were selling into the move are now going to be getting washed out. So, but it's very, very interesting. Kind of, I like, this was actually one of the more calmer FOMC meetings in terms of volatility. Sometimes it's so fast, you just have to sit here and go, well, that was fun. Like, you don't actually get to trade it.
That was fun while it lasted. Not very long.
Yeah. But sorry, I don't mean to rant. Go ahead.
No, you're good, man. I want to jump back into, so this is where Jerome Powell is going to start taking some questions. So let's jump into some of the questions. Hopefully we get some good ones. And then we'll kind of pause periodically and get some of our guest
Associated
takes.
Press, thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called core non-housing services where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions. Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
We're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data.
He's excited.
So
he's excited about the jobs numbers. So I guess because a lot of people have been saying unemployment needs to go to 4.5%, 5%, 6%. Does this tell you guys that that's not necessarily true anymore if other factors are kind of playing a role? Robin, what do you think?
I don't know. I just think that he seemed excited. Well, the last sentence he said there was inflation's coming down, and obviously the labor market is favorable. So what they're doing is working, and not too much outside of what we expected. Another interest rate hike, get to 5%, and then inflation's coming down. I do think at June, with the year-over-year number from the all-time high, could see us around that 2% or sub 2% mark, which is what they're trying to hit. And if we only have 2 more meetings before June, and hey, it kind of all lines up, right?
And then we're 1 year away from the Bitcoin halving.
Yeah.
Caleb, any takeaways from what JP said so far, whether it's with the unemployment, the disinflation, any general thoughts?
I mean, he's kind of just hitting the nail on the head, right? And he's not telling the market anything it doesn't already know. And the one thing for sure is that markets hate uncertainty, right? And so he's providing a lot of reassurance about what the market feels fairly confident about. And so this is basically allowing the market to double down on its confidence about the direction of inflation, the strength and resiliency of the labor market. I still think that the Fed would like to see the unemployment rate tick up a little bit, and see some softness return to the labor market. We were talking about the JOLTS data earlier. But so far, right, and this is key, is so far we've seen inflation decelerate while the labor market has remained extremely resilient and tight, right? So the Fed kind of has proof, at least this point, basically, 9-10 months into their tightening cycle, that they can raise rates. They can front load the rate hikes. They could carry out these final, 0.25% rate hikes. And so far, the labor market has been able to take that on the chin and continue fighting back. So from their perspective, I think the Fed right now feels fairly confident in their ability to engineer this kind of soft landing. Markets are interpreting that. And clearly, we've seen a massive kind of momentum thrust just here in the last 15, 20 minutes off those lows during Powell's press conference. And things are just kind of continuing to grind higher. So the market is digesting all of this known and unknown information and reflecting it in terms of the price. And so prices right now are at least telling us that the market is giving the Fed 2 thumbs up.
And you hit the nail on the head, Caleb, is traders do not like uncertainty. That is why during, now we have a split Congress. That's part of the reason why I believe stocks kind of rallied. Because they know how hard it is to get something passed when there's a united, Congress and presidency, which we had during the last cycle. And now that it's split, they know that nothing big is probably going to happen. And so they can feel comfortable putting money and liquidity into the market. Let's get back to what JP has to say.
But, we'll update those forecasts in March.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently. And I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation. Quits are still at an elevated level. So by many indicators, the job market is still very strong.
It's starting to see Bitcoin move as well.
Colby Smith with the Financial Times.
Right now.
Yeah.
Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward, or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done. And inflation springs back and we have to go back in. And now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten. But if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far.
Okay.
Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good.
And that's actually, just pause it real quick. That's actually what Neil Kashkari said a few years ago. They said the Fed thought that the demand for service or for goods would shift to demands in services and kind of balance out the supply and demand, the supply chain. That didn't happen, right? Everyone's locked down, goods go up, services are down, and they expected people were coming out of lockdowns as services. People wanting services, they'd spend their money there, but that didn't happen. And so this kind of makes sense. But I think it's traders are going to see what he said and said it looks like our policies are making their way through the markets. I know Dow is moving up. I know the SPX is moving up. I know the S&P and Nasdaq's moving up.
Bitcoin's moving up too, man.
Bitcoin's moving up too.
2342 right now.
Yeah.
So
2342. So yeah, let's go back to the video and then we'll kind of wrap this thing up. As far as
this is a good thing, but that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good. And we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same. And, we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy. And so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet. And I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will. fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we've learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
So he pretty much just confirmed we're going to see two more rate hikes, right? 5.1 is our terminal rate. We're at 4.5 to 4.75. So two more quarter basis point rate hikes will put us at that 5.5 to 5.25 level. And so,
and I'm telling you that's the two meetings would be March and May, and then June we're coming off of our year over year all time high, and so I do think we'll be pretty damn close to the 2%, at least I would say 3% in that range. I mean, I think in a kind of a bearish outlook, just because of how high it was in June of that last year. And so, yeah, I think it's no coincidence that those two numbers are lining up. Everything's lining up for this June 14th meeting to be, hey, no interest rate hike. And we haven't seen that for over a year now. So
I think a pivot is completely out of the question this year. But moving into next year, who knows? And that'll kind of line up with the Bitcoin. Having.
Think about how that bullish narrative for him to have one of these meetings that come out and be like, hey, we're not raising interest rates anymore. To say, hey, the job is done, right?
But I think to Caleb's point, right? I think the traders are finally saying, all right, we know what they're going to do. We're going to see two more, 25, and then a pause. Now they're like, okay, now we know how to allocate our funds. Should we put it in risk on assets, risk off assets, commodities, blah, 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 blah. Any kind of parting thoughts on Jerome Powell, what he said, what to expect? I'll start with you kind of first, Magic.
Yeah, I actually thought that was, I mean, as we say, par for the course, but actually I thought that was fairly positive compared to what we had seen previously. Just some of the little things that he kind of indicated where he mentioned, they've said it before, but we're going to be a data-driven committee basically, and we're going to make decisions based on that. He alluded to that they might only do one more rate hike almost. I mean, it was one of those things where he's like, we're open to it. It's just a matter of what the data says. So I agree for right now, we kind of have to assume they're going to keep going on the rate that they are. But it definitely opens up the door a little bit for the markets to kind of try to move to the upside. How the traders, as you said, I would say not me, but like as the market as a whole, if you've noticed, even in the bad news, they've been really just looking for a reason to buy. It seems like I think there's been a lot of sideline money. People are looking to get back in. Not that the dollar is not a great investment as it's tanking right now, but that's how I would take it. So I think that we do have this extended upside rally in the beginning of the year, something we've been kind of looking for from a technical standpoint, and now this is kind of supporting it as well from the macro.
And then Magic, it looks like Bitcoin is at 23, almost 23.5. And so I'm looking at the 30-minute and the 1 hour. We saw a nice big green candle. And then we're seeing another one. Do you mind pulling that up real quick and kind of, telling us what you see, what the order flow is telling us, what volume, just in general?
Yeah.
Telling us what volume, just in general.
Yeah, you've come up to some resistance here. So again, I like to start on the high time frames anytime I'm marking out my levels. And this was actually 23.4 is a really big level to be reclaiming previously. So if you notice, you actually tried to pseudo swing fail it initially, because when we first came up here, you chopped around for a few days before finally taking it out. So reclaiming this on a local time frame makes me think we could retest like the weekly open up here, where you can see that resistance really is coming in. And that would be the ultimate play for me. So just going level to level with it, you can see there's going to be resistance. Where you're going to be finding yourself probably in a bad spot is if you start, losing like 23,000. And one thing you can do that's a really easy trend calculator is you can do things with sessions, or you can do things with dailies, and you can just say, okay, where's all the volume coming in at? And if you look, it's really coming in all around 23 to 23,000. 23.1 to 23,000 right now. So these are going to be your point of control. So if you start losing these on like a retrace and it starts turning to resistance and the point of controls are shifting down, so to speak, that is when you can start saying, okay, the most transactions that are occurring at lower and lower prices. And so then you're just kind of like, it's just like a moving average. What's the slope of the moving average? Is it down or up? So for me, I'm just looking into this area going, okay, that's also the VWAP. It makes sense. If we lose this area, how many longs are coming in up at the top? Do we have trap traders? Do we have the juice to push this much, much lower? And you can see that longs are actually coming off up here. So what that tells me is longs are coming off. People are just taking profits. So that's actually not anything too bearish. It's pretty neutral. So it might chop around up here, may even do a quick flush, try to suck some people into a short. But I'm not really looking for anything too drastic in terms of downside just yet. So I'm still looking for that upside target until price tells me otherwise.
Okay. What about you, Caleb? Any final thoughts on Jerome Powell? Well, what he said in the press conference, his kind of sentiment moving forward, and maybe just in general.
I'll just repeat the comments I shared earlier, which is that Powell is giving the market enough confidence and reassurance about the future path of monetary policy and the positive signs that we've seen so far in terms of a decrease in inflationary pressures and a strong and resilient labor market. And so, like we said, is one thing that markets hate is uncertainty. And so when the market has a little bit more certainty about the future and certain risks or perceive the risks, it's going to, generally kind of shrug off those concerns and celebrate a bit higher. So that's the dynamic we're seeing today. I don't think that Powell's press conference, one way or another, is necessarily hawkish or dovish. The market is certainly interpreting it as if it's a dovish comment. But again, I think everything comes back to this dynamic around certainty and uncertainty. So, clearly the Fed is giving itself enough wiggle room to adjust policy depending on incoming data. They're not going to be married to any single narrative or path forward. All they know is that inflation is still too high, but it is trending in the right direction. So this massive pop that we're seeing in risk assets, across the spectrum today as a result of Powell's press conference is kind of reaffirming this dynamic and possibly setting us up for more continued momentum to the upside. We had talked earlier about my views on Bitcoin dynamics trading above that 200-day moving average cloud. I've done other posts on Twitter talking about short-term holder realized price, long-term holder realized price. All of these levels, both the on-chain data and statistical indicators, are telling us that momentum, at least for now, is to the upside. And so long as we remain above those kind of dynamic lines in the sand, if you will, that, likely it's going to be the case that bullish momentum is going to continue. So, for now, markets are saying party on. So markets are going to party.
Let's get a party, baby.
Party.
I also like what Magic was saying, where he alluded to money being on the sidelines and people itching to get back into the market. I do think
are they scratching that itch now?
I do think a lot of people are kind of like, hey, that's why you're getting so much. Is the bottom in? Is the bottom in? Because people want to pile back in. They're looking for a good entry point. We're seeing it not only in crypto markets, but in the broader markets as well. And we're getting a pretty healthy rally across the board. The NASDAQ up 2% now. The S&P 500 over 1%. This did open up the day in the red. So we are seeing some buying across the board, which could be and will probably be healthy for crypto as well. Also a big breakout on Cosmos as well. Cosmos is pumping. That's probably one of the biggest pumps. Yeah, winners right now. Up 10% on the day for the most part. There are some other ones, but that's one of the biggest projects pumping here in the top 10. I don't know where my And it's awfully bright here. So,
Yeah, it is
and as we mentioned, Bitcoin at 23,445. So
everything's rallying.
Yeah, everything's rallying, man.
Awesome. Well, Caleb, we are going to let you go, my friend. Thank you so much for joining us. We told you an hour, we kept you for an hour and a half. So we appreciate your time. We appreciate the knowledge you bring. Guys, if you like Caleb's analysis, go support him. Go follow him on Twitter at Caleb Franzen. Also, you want more insight into macro and Bitcoin, make sure to subscribe to his free newsletter. The link to that is in the description of this video. Caleb, thank you again. We definitely look forward to bringing you on, my friend. Enjoy your weekend, and we'll see you next time.
Hey, peace, guys. Thanks for the chance to come on. We had a lot of fun. So, hey, market's partying. I'm going to go take a shot. So I'll see you guys soon.
There you go.
Whoa. What are you taking a shot? What's your shot?
Yeah, what's your shot of choice?
I'm kidding, man. But if I was going to take a shot, it would have to be some tequila, 100%.
Ooh. Are you a Niejo? Are you a Blanco? Are you a Reposado? What are you?
You like coloring that thing or what?
I like some reposados. I love mezcal for like my spicy margaritas. So,
I hate mezcal, bro. I can't stand that smoky
mezcal?
flavor. Yeah,
I'm never coming back again, bro. I'm never.
What?
Coming back.
I mean,
Hey,
Robin likes mezcal.
Yeah, hey man, you know
we're hedging
what?
our bet here. Robin likes
take
mezcal.
a sip and then you smell like a man,
exactly.
you know. So.
Hey, cheers, guys.
Cheers, man.
Look forward
Thank you,
to
buddy.
talking again soon. And
Thanks for joining
this
us,
was a lot
brother.
of fun, so.
Definitely appreciate it, man. Take care.
All right, guys. Peace.
All right, Magic. Let's take a quick before we let you go. We're gonna hold you hostage for a little longer. Can we just take a quick look at the Cosmos Atom chart? If you were in a long, right, and you're riding this pump, what are some levels you should be looking at taking profit, and or just completely exiting your position? And if you're looking to get into Atom, what should you wait for retracement to?
So this one is kind of gave the retracement here. I was actually watching this for a Gartley pattern. So it was a nice reversal pattern. It actually front ran me a little bit. You can see that it barely tapped the box. The target on this one is usually the gold pocket or like the range high, depending on how you want to pull it. And you can see you've already achieved that. So in reality, you actually need to get new targets, right? So that's what we'll do real quick. You can see you're up at the range high already. With something like this, I would normally default to a fib pull, mainly because, you know, we have our horizontal levels above us. You can already target the high here on C, and that's just giving you a pivot point in the market at about $15.40. I would say you could probably extend that down to like $15.36, give or take. But you can do a trend-based pull on this because this is something that does make a new trending move. So you're just going to go X to A to the low because you just need to see exactly where it's going. And I'm going to get rid of this real quick just to hide it. And it's letting you know that 1562 is going to be your next area of resistance. I would box this off, especially if markets are going to continue, because you do have a major average from 2021 coming in there. So again, horizontal average at 1645. I would say right here is a great place to be locking in some profits. Anything above that though, and you're probably going to run it to $19.30 to 89 cents. This box right here. And this is a big box, to be upfront with you. This is one that I've had on my chart for quite some time. This is going to be the annual pivot for this asset. Much like Bitcoin, it's actually above quite a bit, but it wouldn't be out of question if you crack this 1645 level to make that initial like $3 to $4 move up as well. So these are the next areas I'd be watching if I was in a long. If I was looking for a retrace, realistically, that's a tough one. Mainly because it's trending so hard. Those can, you know, I'm a pretty conservative person when it comes to like where I'm going to be buying in at. I am one of those people, kind of I guess a bore. But this box right here was derived from this pivot point. So you can see that right there. I'm going to get rid of this real quick. We're just going to hide that. So this pivot point in the market, which was also your B leg on that structure, right? So you can see this is where all the assets were accumulating above this area. This is support, and then expansion to the downside. So again, coming back to this area on the chart would have me interested, especially at the value area low of your current developing quarterly range. Yeah, I'd be interested again. It'd be somewhere between 11 and 12 bucks. I just don't know that we're going to get it. At this time, I would just be, if you're a breakout trader and you're already long, you're happy. I always say lock in gains if you're a breakout trader as soon as you can. But realistically, I would be looking up towards here first. I don't see any reason why we won't come up to this box, take out the high here, and potentially push into like 1645. Yeah, hopefully that's helpful. But if you're wanting to know what level to hold, 1309. If you lose 1309 on like a daily closing basis, I would expect to come down to like probably 1120, give or take.
Amazing. Magic, your stuff is good as always, man. Guys, if you enjoy Magic Internet Money, go follow him on Twitter at MagicMoneyM1. Also, go subscribe to his YouTube. That link is in the description of this video at Magic Internet Money. We appreciate you as always, my friend. Thank you so much for joining us. What? Oh,
absolutely. Hey, no, I was saying thank you. I didn't realize I was unmuted. So.
Oh, you're good. Rocco was giving me these weird Italian signals. He was hanging about me. Are you also going to go take a shot?
I am not. So I'm going to take my dog for a walk. I can hear him trying to get into my office. I've got a Airedale Terrier that's like 100 pounds, and he demands some of my time. So yeah, he's awesome, a big boy.
Well, we will let you get to your dog. And we appreciate you, my friend. Thank you so much for joining us as always. We look forward to bringing you on again in the very, very near future. And have a great weekend, and we'll see you next time.
Thanks for joining us, bro.
Thanks, guys. See you later.
Peace. All right, we got to give a little love to the chat as well. We haven't had intermission here in a minute. Yeah, so if you're new, say hello. So that way we can drop an hola back at you. That's hola without the H. And so we got Ivan Hernandez, Robert Harmon, Joseph Miller, Michael K, Rhino, Nick Seals, David Talley, Doug Yoder, Hip Hop. We also got Matt N. And we also have Hans Werner, Peace Love, Drew Z88, Asif Khan, and Barbie Rash. To all of you, hola! Welcome to Sin City Crypto. Also, we had Avinash Bakal. Hola.
Avinash. All right, guys, we're done. Go follow us on social media, Sin City Crypto 1 on Twitter. Also, check out all other social medias and all the other links that we have. Every single link we have, all the links, they're there. Also, go support our guests who join our show. Their links are in the description of this video as well. So with that being said, Rocco. Friends, family, friends, and family friends. We thank you guys so much for joining us on this FOMC special. Make sure to come back tomorrow at 10:30 a.m. Pacific Standard Time. We have special guest DZ joining us from the Hit Network. We're going to talk NFTs. We're going to talk a lot of stuff. So make sure to join us. Have for myself, Robin, Kyler, and Rocco. Love you guys. Until then. I got a piece